On August 4th, 2026, if you had been watching the SEC's EDGAR system in real time, you would have seen something strange scroll past, filing after filing, all landing on the same calendar date, all from the same small cluster of household name banks. JP Morgan Chase, Bank of America, Wells Fargo, Morgan Stanley, Citigroup. 11 separate documents, 5 different issuers, one single day. Each one is labeled with dry, bureaucratic language. Form 424B2, Form 424B3, Form FWP. Pricing Supplement Number 109. To most people, that string of letters and numbers means nothing. But strip away the jargon and what you're looking at is the paper trail of a machine, a retail structured products pipeline that runs every single business day, largely unseen by the people whose money eventually flows through it. Here's the thesis of this video. What looks like routine SEC paperwork is actually evidence of a systematized, industrial-scale production line for retail structured notes, and its sheer volume and velocity are almost invisible to an ordinary investor who only ever sees one note, one pitch, one pricing supplement at a time. On August 4th, 2026, 5 of the largest banking institutions in the United States, JP Morgan Chase, Bank of America, Wells Fargo, Morgan Stanley, and Citigroup, each filed at least one Securities Act Rule 424B, prospectus supplement or free writing prospectus with the SEC, all dated the same day. That's not a coincidence of timing you'd expect from a handful of one-off deals. It's the visible tip of a continuous issuance system. When we look closer at the filing numbers themselves, not just that they exist, but how they're numbered, the picture gets even more striking. Start with JP Morgan Chase, because it filed more documents on this single date than any other issuer in the ledger. At least 5 separate Rule 424B or FWP documents, all dated August 4th, 2026. There's a Form 424B3 filed under the accession number on screen. There's another Form 424B2, a preliminary pricing supplement, under the accession number on screen. There's a straightforward Form 424B2 pricing supplement under the accession number on screen. There's a second Form 424B3 under the accession number on screen. And there's a Form FWP, a free writing prospectus, under the accession number on screen. 5 filings, 5 accession numbers, 1 bank, 1 day. That alone tells you this isn't a single note being carefully rolled out. It's a production schedule. JP Morgan wasn't filing alone that day. Bank of America filed 2 separate Form 424B2 documents, one under the accession number on screen and a second, distinct filing under the accession number on screen. Wells Fargo filed 2 Form 424B2 pricing supplements as well, pricing supplement number 109 under the accession number on screen and pricing supplement number 68 under the accession number on screen. Morgan Stanley filed a Form FWP tied to a preliminary pricing supplement, and Citigroup filed a Form 424B2 preliminary pricing supplement of its own under the accession number on screen. Added up, and 5 distinct large bank issuers each filed at least one Rule 424B or FWP document on the exact same calendar date. That's the baseline fact of this story. Not one bank having a busy day, but 5 of them, simultaneously, doing the same kind of paperwork. Now look past the accession numbers to the sequence numbers printed right on the documents themselves, because these are arguably the most revealing detail in the entire ledger. Morgan Stanley's filing is labeled a free writing prospectus tied to preliminary pricing supplement number 17,650. That single filing, sitting in a sequence that has already reached that number, indicates a cumulative sequential numbering scheme that has climbed to at least 17,650 pricing supplements by this date. Wells Fargo's 2 filings on the same day are numbered 109 and 68, 2 different numbers, filed the same day, which tells us Wells Fargo is running at least 2 concurrently numbered sequences of pricing supplements at once. That pattern, 2 live counters ticking in parallel, suggests, hypothetically, that Wells Fargo has filed well over 100 such supplements in one sequence and dozens more in another sequence by this date, since we don't have the full historical run of filings to confirm the precise starting point or cadence of each counter. But even without that full history, the sheer size of Morgan Stanley's counter alone in the 5 digits tells you these aren't rare, bespoke instruments. They're manufactured on a schedule at a volume that most retail investors never see reflected anywhere in the marketing material handed to them. A fair skeptic could push back here. Of course, large banks with active structured products desks file paperwork every day. That's simply the nature of a highly regulated securities business with dozens of active offering programs running in parallel. Filing volume by itself doesn't prove anything sinister. It could just as easily reflect efficient, compliant, well-oiled back-office operations doing exactly what they're supposed to do. That's a reasonable point, and this ledger, on its own, doesn't tell us whether these 5 banks filed more or fewer documents than usual on August 4th. We have no baseline for typical daily volume to compare against. There's also a broader interpretive claim worth flagging directly. The idea that this filing pattern reflects a systematized, high-volume production pipeline that's largely invisible to individual investors evaluating a single node in isolation is, in this ledger, as an opinion that has not been independently verified. It's a reasonable reading of the pattern, but it remains an interpretation rather than an established fact, and reasonable people could disagree about how deliberately invisible that pipeline actually is to a motivated investor who chooses to look. Let's be precise about the limits of this evidence, because they matter. This ledger tells us the existence, form type, issuer, and accession number of each of the 11 filings dated August 4th, 2026. It does not tell us the underlying note terms, no notional amounts, no reference assets, no strike levels, no maturity dates, no coupon structures. We don't know whether these are principal-protected notes, autocallables, or something else entirely. We also don't have any data on typical daily filing volume across the industry, so we can't say whether August 4th was an unusually busy day or a perfectly ordinary one for these 5 banks. And there's a forward-looking claim worth naming plainly. The notion that this issuance scale, based on sequence numbers like Morgan Stanley's 17,650 or Wells Fargo's 109 and 68, will keep growing in future filing periods as a forecast that remains unverified here. We have a single snapshot in time, not a trend line. So any claim about future growth is speculation rather than demonstrated pattern. So why should any of this matter to someone who isn't an SEC compliance officer? Because the practical takeaway is about scale and context, not about any single note being good or bad. If you're ever handed a structured note by a financial advisor or a bank's retail desk, that document will almost always be presented to you as a standalone opportunity, tailored, specific, seemingly custom-built around your goals. What this ledger shows is that the same institution filing your note is, on that very same day, filing several more just like it, and its competitors are doing the same thing in parallel. 5 distinct large bank issuers each filed at least one Rule 424(b) or FWP document on the identical date, and JP Morgan alone filed 5 documents that day. A sequence number in the thousands, like Morgan Stanley's, points toward a production process that runs on a schedule rather than being built fresh, one investor at a time. Wells Fargo's 2 concurrently numbered sequences on the same day point the same direction. Though reading that pattern as evidence of a much larger overall count remains hypothetically, rather than a confirmed figure, since the full history behind each counter isn't in front of us. Understanding that context doesn't tell you whether a particular node is priced fairly or suits your situation. It simply means you're evaluating it with a clearer sense of the machine it came from, rather than treating it as a unique, handcrafted instrument built just for you. If you take one thing from this video, let it be this. Before evaluating any single structured note, it's worth checking whether the issuer filed it as part of a broader batch on the same date. That context is publicly available on SEC EDGAR for anyone willing to look. This isn't financial advice, and nothing here should be read as a recommendation to buy, sell, or avoid any particular note or issuer. Structured products carry their own complex risks that depend entirely on terms this ledger doesn't cover. What we can say is that the paperwork itself tells a story of scale that rarely makes it into the pitch. If you found this breakdown useful, subscribe to the Source Ledger, where we keep digging through the public filings that hide in plain sight. And let us know in the comments if you'd want a follow-up that pulls the actual note terms behind one of these filings.